Most commonly given GFOA comment. Great session for those of you that are interested in completing your financial statements without getting comments back from GFOA. We've taken some time to address what we see as the most commonly given GFOA comments. A summary of the most commonly given GFOA comments. These comments relate to fiscal years 23 and 24. Some things to think about is GASB 87 was required to be implemented in 2022, and the subscriptions was required in fiscal year 23. A lot of these comments in here are off the cusp of the implementation of new standards. The first item there, terminology and formatting, are the most common comments given by GFOA. If you look at that, more than 1,250,000 comments in fiscal year 23. While it was nice to see that drop in fiscal year 24, still a lot of comment revolving around terminology and formatting. The other thing that I'd like to call out here is just the technical side: debt, leases and subscriptions, fund balance classifications, fair value of investments, pension, and OPEB. Those are all more complex areas of financial reporting and disclosures. So it's not unusual to see those as the areas where there's more tendencies to get comments. Finally, I think the volume has decreased over those high levels in 23 and 24. So it'll be interesting to see how things appear next year for fiscal year 25. Those comments aren't out yet. You might recall that fiscal year 24, there wasn't any new standards to implement. You look at GASB 100, which is restating beginning balances. There was a clarifying standard in how you might address changes to that beginning balance versus reporting something new, like changing the way you report compensated absences in fiscal year 25. I'm curious to see if there'll be an uptick in comments based on that new standard for fiscal year 25. As it stands now, these are the comments. 27,800 in fiscal year 23, dropped down by 8,000 to about 19,000 comments in fiscal year 24. Heading the right direction, but let's see what we could do to address some of these issues to avoid these comments in the future. We've summarized the most frequently cited reviewer comments, the top 4. MD&A, clearly the most commented on section of the ACFR. In the next section, we're going to give the top 10 most frequently commented areas of the ACFR, and the MD&A is in there a couple times. Why is that? There's been more focus to present a narrative that goes beyond just explaining percentages or amount changes and underlying reason why things change. Secondly, terminology and accuracy still are issues. We're going to cover that in more detail. Long-term obligations, as I mentioned, some of these areas revolve around more technical aspects of financial accounting and reporting. When we look at the long-term obligations, whether it be pension or OPEB, whether it be leases or subscriptions, or just long-term debt in general, we know there's a lot of disclosure in that area. Those tend to be where a lot of comments are centralized. The net investment in capital assets has been given a lot of attention, or more attention, since GFOA requires that calculation be presented as part of the packet. And I think it's clear that their interest is, how is this number calculated, and is it calculated correctly? Because we can't tell by looking at the face of the financial statements. That increased scrutiny has led to more comments in that area. We commonly refer to that as the NICA calculation, but that's a component of the net position. Finally, internal consistency challenges. We see a lot of numbers that aren't consistent throughout the report, whether it's between the MD&A and the financial statements, whether it's between the notes in the financial statements, whether it maybe is information presented in the statistical section. There's quite a few comments that relate to presenting the numbers accurately throughout the report. Those are the 4 most common areas that we're seeing, but we're going to dive into the top 10 in the next section.
In the next slides, we will be highlighting the top 10 most common comments from GFOA for fiscal years 2024 and 2023. We'll break down these comments in more detail and look at examples of how to address them effectively. The first comment is MD&A lacks explanation of fund balance changes. This is consistently the single most common MD&A comment reviewers issue. Too often, MD&A tells the readers what changed in fund balance, but not why it changed. We see statements like revenues increased or expenditures decreased without explaining the drivers behind those changes, such as economic, policy, or operational drivers. Why does this matter? Because MD&A is written for non-expert readers, such as the public, elected officials, and oversight bodies. If it doesn't explain the underlying causes, it doesn't add much value beyond the numbers already in the statements. So, reviewers flag this because CASB expects MD&A to provide meaningful analysis, not just a restatement of financial results. In order to fix this, it is a mindset shift. You need to connect the financial changes to real world events, for example, tax rate changes, development activity, grant timing, staffing decisions, or any one time items. When MD&A explains the why, this comment usually goes away. To give you an example, a common MD&A language that we see is general fund balance increased by 3.5 million due to higher revenues. An improved explanation could be general fund balance increased by 3.5 million primarily due to a voter approved 2% property tax rate increase and higher assessed values from new commercial development. Expenditure growth was limited due to delayed hiring in public safety and lower fuel costs. The key takeaways for this comment are MD&A must explain the why, not just the dollar amount or percentage. Reviewers expect links to economic, policy, and operational drivers, and clear explanations will greatly improve MD&A usefulness and reduce comments.
That brings us to number 2, outdated terminology. Now, this issue is one of the easiest reviewer comments to avoid, and yet it continues to show up year after year, as evidenced by the graph in the first few minutes of our presentation. Reviewers frequently flag the use of outdated terminology, such as the comprehensive annual financial report instead of the annual comprehensive financial report, or utilizing terms market value instead of fair value. These terms are no longer consistent with current GASB standards and are outdated. While it may feel minor to use this terminology, it signals that a report has not been updated for current guidance, that it's not up to date. Reviewers can avoid these red flag or cut and paste issues by making sure that you review and replace these outdated terminologies as you're preparing your report each year. The key takeaways for this one is technology matters. It reflects compliance with current standards. These are easy repeat comments to eliminate. Global search will catch these outdated items as you update your report from year to year.
The next comment is about incomplete presentation of direct and long-term debt. This comment is all about completeness, not complex accounting. Governments often present long-term debt that includes bonds, but omit other debt obligations such as leases, notes payable, certificates of participation, PPPs, or SBITAs. The result is an incomplete picture of direct debt, even when the individual liabilities are recorded correctly elsewhere in the ACFR. And why does this matter? Because CASB and GFOA expect readers to see all direct long-term obligations in one place, particularly in debt disclosures and the statistical section. Omissions distort debt burden ratios, debt limits, and multi-year comparability, and reviewers catch this quickly. The fix is procedural. Maintain a complete inventory of all long-term obligations, regardless of form, and ensure those obligations are included consistently across the notes, statements, and statistical tables. To give an example, government reports in the notes bonds of 75 million, lease liabilities of 6 million, and certificate of participations of 4 million. In the statistical table, the government only reports 75 million of bonds. The result is that the direct debt is understated. The correct approach is to report the total 85 million of direct debt in the statistical table, which includes bonds, leases, and certificates of participation. The key takeaways for this comment are all long term obligations belong in debt disclosures, not just bonds. Most comments stem from incomplete debt inventories, not math errors. A single comprehensive debt listing prevents repeat comments.
That brings us to item number 4. Now, a top 10 list wouldn't be complete without some mention of pension and OPEB. Am I right? GFOA does not fail to meet expectations. Here we are again, more than 10 years after the implementation of pension and OPEB standards. They're still commenting on missing or incorrect information in the reports. This one's very specific. Pension and OPEB liabilities due within 1 year. We've been seeing an uptick in these comments and maybe a better understanding of what this means in recent years. Hopefully, this comment starts to go away as people are more understanding of the criteria. When a pension or OPEB plan is not administered through a trust, GASB requires that benefit payments due within 1 year be reported as current liabilities. What often happens instead is that governments classify 100% of the liability as non-current without evaluating the payment schedule. So why does it matter? First of all, it misstates liquidity and reduces clarity in the financial statements. Reviewers catch this quickly because it's not judgment-based, it's a classification requirement, and the fix is straightforward. Confirm, first of all, whether the plan is trust administered. Review the expected benefit payments for the next year and ensure that the current non-current split agrees between the financial statements and the footnote disclosures. If these 3 things align, the comment usually disappears. An example is you have a total OPEB liability of $12 million, and there is no trust set up to make those benefit payments. The benefit payments expected for the next year, let's just say, is $900,000. So the correct presentation would be splitting that $12 million on the statement of net position between a current liability of $900,000 and a non-current liability of $11.1 million. The common error there would be reporting all $12 million of the OPEB liability as non-current. The key takeaways on this comment is that non-trust plans require a current portion due within 1 year. This is a mechanical issue, not judgment. Early review of payment schedules will prevent a high-frequency comment.
The next comment is about errors in calculation of net investment capital assets. Net investment in capital assets, or NICA, is one of the most technical and most frequently commented areas in the ACFR. Errors typically occur because governments don't include all capital-related assets and liabilities in the calculation. We still see lease liabilities, SBITAs, PPP liabilities, retainage, or deferred amounts on refundings that are related to capital assets, either omitted or inconsistently treated. However, in some cases, non-capital liabilities like pensions are mistakenly included. So why does this matter? Because NICA is a key component of net pension, and errors often signal that capital assets and long-term obligations were not fully inventoried or reconciled. Reviewers also routinely find that the certificate program worksheet doesn't tie to the ACFR, which almost guarantees a comment. The fix is discipline and documentation. Maintain a clear, repeatable NICA worksheet that includes all capital-related assets and liabilities, and perform a final tie-out to the ACFR before submission. To give you an example, the government reports capital assets net of 150 million, related debt and liabilities comprise of bonds of 60 million, lease liabilities of 8 million, and beta liabilities of 2 million, which totals to 70 million. The common error is that lease liabilities and beta liabilities are excluded in the calculation, which results to NICA being overstated. The correct approach is to include lease liabilities and beta liabilities in the calculation so that correct NICA should be totaling to 80 million. The key takeaways for this comment are: include all capital related assets and liabilities regardless of debt type. Exclude non-capital liabilities like pensions and OPEB, and ensure that the NICA worksheet ties to the ACFR and certificate submission.
Number 6, lease assets not properly disclosed as capital assets. First off, we should say that these comments go back to fiscal year 23, which was not the initial year for June 30 clients, but soon after GASB 87 was adopted in fiscal year 22. I don't know where they would put calendar year organizations. Would they be in the fiscal year before or after the one being presented? Regardless, leases was new at the time that we're evaluating these comments. It's not surprising to see leases in the top 10 just because it was fairly new in fiscal year 23. Under GASB, leases are right to use capital assets, but we see them labeled separately from capital assets on their own or buried in other places and not being combined with capital assets. It's not clear that the leases are part of the capital asset balance. Now, this will be increasingly important because in fiscal year 2026, governments will start to implement GASB Statement 104, which has to do with the disclosure of capital assets in the financial statements. So it's important that we clearly label and treat those leased assets as capital assets. An example would be if you've leased a $5 million building under GASB 87, you want to make sure that $5 million asset is sitting in your capital asset roll forward as an addition, as a balance that's amortized over that lease term. And the accumulated amortization should also be an element of that disclosure. The key takeaways for this slide is that leased right to use assets, and not just leased assets. You could also apply this comment to the SPITAs, the subscription-based IT arrangements. We could apply this to GASB 94 for the triple Ps, the public-public partnerships or the public-private partnerships. These are intangible right-to-use assets. And the labeling matters in terms of recognition. These leased assets should be consistent and reconciled between the amounts reported in the financial statements and the amounts reported in the note disclosures.
The next comment is that beta liabilities are missing from debt disclosures. SBITAs are one of the newer trouble spots we're seeing in reviewer comments. And the issue usually isn't recognition, it's completeness. Subscription-based IT arrangements often get missed in debt disclosures even when the liability and asset are properly recorded. That's because SBITAs are frequently managed outside of finance by IT or procurement, so they don't always make it to the government's long-term debt inventory. Reviewers typically flag two things. Number one, SBITA liabilities omitted from debt schedules. And number two, missing or incomplete future payment disclosures. This creates the appearance that long-term debt obligations haven't been fully evaluated. The fix is process-driven. Governments need a complete inventory of all SBITAs, coordination with IT and procurement, and a standardized checklist to ensure SBITAs are included consistently in the statements, notes, and debt tables. To give you an example, government enters into a 5-year cloud software contract and records 3 millions beta asset and liability, but did not include in long-term debt disclosures or debt schedules. So the result is incomplete debt disclosure. The correct approach is include this beta liability in long-term debt tables, disclose future subscription payments in the notes, and ensure totals tie across statements and schedules. So the key takeaways for this comment are beta liabilities are long-term obligations and belong in debt disclosure. Most issues stem from incomplete inventories and cross-department gaps. Checklists and coordinations will prevent repeat comments.
Number 8, inconsistencies between MD&A and the financial statements. I told you there was multiple MD&A comments, and there's 2 in the top 10. This comment has nothing to do with complex accounting. It's just about internal consistency. Reviewers often find that MD&A doesn't agree with the financial statements, whether it's different dollar amounts, outdated explanations, references to items that no longer appear in the financial statements. This usually happens because MD&A is drafted too early or updated manually after information changes. So why does it matter? First of all, MD&A is meant to be a roadmap to the financial statements. When the story doesn't match the numbers, it undermines the credibility and signals weak quality control, even if the accounting is technically correct. The fix is procedural, not necessarily technical. Finalize the financial statements first, then update the MD&A last with a deliberate reconciliation step to ensure amounts, terminology, and explanations agree across the report. A simple example might be the MD&A says the general fund balance increased 4.2 million due to higher sales tax. But the financial statements show an increase was 3.6 million, primarily from property taxes, not sales taxes. So the reader's confused looking for this big increase in sales tax when really it was property taxes that increased. The takeaways here is the MD&A should explain the statements, not contradict them. Inconsistencies signal process issues, not accounting errors. Finalize the MD&A after the statements and notes with a formal tie-out step.
The next comment is that statistical tables do not agree with financial section. This comment comes up because the statistical section spans many years and it's usually updated separately from the financial statements. Reviewers frequently find that amounts in the statistical tables don't agree with the financial section, whether it's outstanding debt, revenues, or expenses. These differences often result from rolling forward prior year tables without fully updating them for current year activity or changes in presentation. Why does this matter? Even though the statistical section is supplemental, the certificate program expects internal consistency across the entire ACFR. When numbers don't tie, reviewers assume there wasn't a final cross-check, even if the financial statements themselves are correct. The fix is procedural. Clearly document the data source for each statistical table, update tables after the financial section is finalized, and perform a final reconciliation between the statistical section and the financial statements before issuance. To give you an example, let's say financial section shows outstanding long-term debt of 82 million, but the statistical table reports 79 million because a lease liability wasn't updated properly. The result is that the numbers don't tie. The correct approach is to update the statistical tables after the final numbers and tie the numbers directly back to the financial statements. The key takeaways for this comment: statistical tables must agree with the financial section. Most errors come from roll forward and update timing issues, and a final reconciliation step eliminates this common comment.
That brings us to our final top 10 item, the transmittal letter. Now, it probably shouldn't be any surprise that both the statistical section and the transmittal letter are common comments. Because they're not audited information, they may not get the attention that they deserve from the auditors. Oftentimes, these are the final components that are provided as part of the financial statements. Let's take a look at the transmittal letter. Again, this is not another complex technical matter. It's really an explanation of the required elements transmitting the document. Reviewers frequently flag transmittal letters for missing or incorrect required elements, things like the wrong report title, outdated dates, missing identification of the intended audience, or omissions of required content about the government, the report structure, and financial highlights. First off, why does it matter? The transmittal letter sets the first impression of the entire report. When it's incomplete or inconsistent with the certificate program requirements, reviewers assume the introductory section wasn't fully revisited, even if the financial statements are strong. The fix is simple and repeatable. Use a standard transmittal letter checklist, update it every year, and prepare it after the report structure and terminology are finalized. This isn't about creativity, it's more about completeness and accuracy. The key takeaways here is the transmittal letter is a certificate program requirement, and it shouldn't be boilerplate. Most comments are preventable with a checklist. Finalize the transmittal after terminology and structure are finalized. That was the top 10 list. Thinking back, what are these comments really telling us? First of all, a lot of the comments weren't about complex accounting judgments. They were more about how information is presented, consistency among different sections of the report, and ensuring that the terminology used is updated for current standards. That tells us a lot of these comments are largely preventable. While it seems like they're repetitive, there could be obviously some governments addressing the comments from the previous year and then new comments popping up. A lot of these are repetitive, common errors that we see frequently. They focus on structure, presentation, and consistency, not judgment. The root causes, things like partially implementing new standards, cutting and pasting information from the previous year without really taking a look and making sure that it reflects current information, preparing information like the MD&A or the introductory sections too early, or at least if you're preparing them early, not going back and revisiting them once the financial statements are complete. Not doing or incomplete tie-outs to the financial statements, especially when there's late adjustments or changes in presentation, and not utilizing standard checklists for high-risk areas. These are all things that you could address to really reduce the number of GFOA comments that you receive each year.
Moving on to the next agenda, let's look at auditors' most common review comments. These are the issues we see come up consistently during the review process, and understanding them can help avoid rework and strengthen submission from the start. These comments come from auditors rather than GFOA, but you'll notice a familiar theme: internal consistency and completeness. A large share of auditor review comments fall into three buckets. First, internal consistency errors. Auditors frequently find that notes don't reconcile to statement face amounts, calculations don't foot, amounts are rounded inconsistently, or section titles don't match. These are not complex accounting issues. They are quality control issues that suggest the numbers were not tied together at the end of the process. For example, government-wide statement of net position shows capital assets of 125 million, but the capital asset note totals 123.5 million due to a rounding error. The result is that the face amount do not reconcile to the note, and the auditor flags a reconciliation issue. To fix this error, final crossfoot and tie the note totals to the statement face. The second comment is about cash flows, especially the non-cash activity. Governments often forget to disclose non-cash investing or financing transactions, such as entering into a lease or SBITA. Even though no cash changed hands, GASB still requires disclosure because these transactions materially affect assets and liabilities. For example, government enters into a 4 million lease during the year. The lease asset and liability are recorded, but no non-cash disclosure appears in the cash flow statement. So the auditors flagged the missing required non-cash disclosure. To fix this, just add a brief disclosure describing the non-cash lease transaction in the statement of cash flows. The third comment is about errors in the conversion of governmental funds to government-wide statements. The common misses include capital outlay not being added back, principal payments not reducing long-term debt, or new debt issuances not reflected properly. These conversion entries are mechanical, but they're high risk because they affect multiple statements at once. For example, governmental funds show 6 million of capital outlay that meets the criteria of a capital asset, but the conversion entry fails to add this to capital assets. So the result is that capital assets are understated and depreciation and net positions are incorrect. To fix this, ensure to review all standard conversion entries using a checklist. To summarize, the underlying message auditors are sending is clear. Final tie-outs and cross-checks matter just as much as technical accounting knowledge. Most of these comments disappear with a disciplined end-of-process review. The key takeaways are most auditor comments are mechanical and preventable. They signal missing final tie-outs, not bad accounting. And a structure end of process review for the statements, notes, cash flows, and conversions together will dramatically reduce as audit comments.
That brings us to our third and final section of the agenda, consideration of GASB Statement 103, Financial Reporting Model Improvements. I know the earlier session today talked about a GASB update, including an emphasis on Statement 103. We don't want to duplicate what was discussed earlier, but in light of the comments that tend to focus around implementation of new standards, that tend to focus around MD&A, this is a short discussion that would really benefit those of you that are financial statement preparers as you're getting ready for the upcoming ACFR. As we discussed earlier, Statement 103 has 3 really big changes and then 3 not as widely impacted changes. So 3 big changes is management's discussion and analysis. We're going to spend a little bit of time just talking about things to think about as you implement this new standard. The second, obviously, proprietary fund financial statements. The third is the changes to the budgetary comparison information. So we'll talk about those 3. Not going to focus on the other changes, unusual or infrequent items. If those do pop up for you, you'll need to make sure that they're presented in accordance with the statement requirements in terms of not netting them together and presenting them on the face of the statements, and then disclosing the nature of those unusual or infrequent items in the notes. There's some criteria in there. Just make sure that you've met all that criteria. Same thing if you have major component units and you have multiple component units, you'll want to make sure that those are presented appropriately. If you're a standalone financial statement or you're a business type activity and you present statistical information, that 10-year information needs to reflect the changes to the proprietary financial statements. Here are the MD&A requirements, and there's 5 paragraphs dedicated to MD&A. And as we talked about earlier, there's a lot of changes to what goes into the MD&A and enhancing the quality of the MD&A. Paragraph 8 lays out the criteria. That's really what you want to follow. You've got 5 sections that you need to present the MD&A. You need to make sure that there's better explanations of the underlying reasons why balances are changing versus just that they've changed in maybe a percentage. And really avoiding unnecessary duplication and boilerplate language. Those are the main requirements of the MD&A going forward. As you're thinking about that, definitely recommend a checklist, but let's take a look at the top 3 areas to think about as you're preparing for the changes to MD&A. We've presented the MD&A changes in the form of traps and fixes. The first trap is treating those 5 sections as suggested rather than mandatory. You now have 5 sections that you need to consider. And so you want to present the MD&A in a way that meets those criteria. The trap is using your old MD&A, just cutting and pasting that information into the new MD&A without making sure that you're addressing the new criteria. We want to make sure that we're limiting our discussion to those 5 specific sections and you're not departing from that information. Now, in the financial statement changes section of the MD&A, it lists both the statement of net position and the statement of activities all in one schedule. But in GASB's illustration, it separates the statement of net position from the statement of activities discussion. You're giving the financial analysis after you're presenting the statement of position numbers, and you're giving the financial analysis after you're giving the statement of activities presentation. So that's fine, but you need to make sure that the information presented is following the criteria laid out in the new MD&A requirements. Our tip here is to start with those 5 section headers and then make sure that you're considering the new changes as you're addressing that criteria. Another tip is don't wait till the end of the year when you're in the midst of trying to issue your report to redesign your MD&A. Get an early start, especially for those of you that are presenting comparative financial statements and you need to present your prior year and make sure that's updated in addition to the current year. So get an early start on designing your MD&A. The second trap is relabeling old content without changing the substance of it. As you recall, a lot of the discussion with GASB 103 is to talk about the underlying explanation of why balances are changing, explaining the why of those changes. Simply cutting and pasting narrative from the previous year that may not have met the spirit of the statement as it is now may result in a comment. Take a look at the information that you're performing over to the new year to make sure that you're not just simply carrying over some outdated information. Finally, the last trap is using boilerplate information, especially as it relates to currently known facts that don't affect the future. A lot of times in that last section, we may see generic statements such as management will continue to monitor economic conditions. That's not really a fact. Obviously, management will continue to monitor things, and that's not a statement that is displaying a known fact affecting the future financial position of the organization. So why is that a problem? First of all, it's not helping the reader understand what changes or what impacts are known that may impact the financial statements. You want to make sure that if you're disclosing things that you're tying that to a budget, or you're tying that to a capital plan or a newly negotiated labor contract. Maybe there's some known indicators that are going to have an impact to your future revenues or resources or other policy changes. You want to report these currently known facts in a way that articulates the cause and impact of these changes, not simply general statements. The next big item is proprietary funds, and we talked quite a bit about that in the previous section. What I want to emphasize here is you've got a new category to present, which is non-capital subsidies. and a new subtotal to present, operating income or loss, and non-capital subsidies. You want to make sure you get the statements correct, you get these new captions correct. There is some changes to other non-operating revenues expenses. Obviously, we're moving up transfers in and out, which may go into either category, and you're moving capital contributions into the other non-operating revenues and expenses. The FOA reviewers are going to be looking at those proprietary fund financial statements to make sure they're properly updated for these new requirements. Again, unusual or infrequent items, that's now a category that's a little more simplified than special items or extraordinary items in terms of meeting the definitions. Make sure that those are listed at the end. You're no longer using the terms extraordinary or special items. Those are terms that are no longer in use. And making sure that you're not netting multiple items together. Those are things to think about, making sure that as you implement new standards, you're updating the proprietary financial statements accordingly and not just trying to work within the old statements and missing some of these changes. Finally, the third item of Statement 103 is the budgetary comparison information. A couple things to think about is the schedule itself changes. So you now have a new column to add. Make sure you capture that new variance column and that you're adding those notes to the RSI. If you've presented your budgetary comparisons information in the basic financial statements, that's no longer permissible. And as you relocate these items, both the schedules themselves out of the basic financial statements and the discussion out of the MD&A and into the notes to RSI, how that impacts the report as a whole. When you're changing the location of things, page numbers change. There's a lot of rippling effects of those kinds of changes. So you want to make sure that you're getting the information presented correctly. As we wrap up, we want to leave you with 4 practical focus areas that tie directly back to the reviewer comments that we've covered today. First of all, targeted checklists. Nearly every top reviewer comment we discussed, from MD&A explanations to debt completeness to the net investment in capital assets, all come back to missing or incomplete checklists. The governments that see the fewest comments aren't doing more accounting. They're using repeatable checklists for high-risk areas to make sure that nothing gets missed. Secondly, focus on the right areas. The biggest sources of comments are consistent. We see them consistently reported for MD&A, long-term obligations, capital assets, terminology, internal consistency. If you prioritize your review time in these areas instead of spreading your time and effort evenly, you may dramatically improve the outcomes without necessarily improving the workload. Third, internal consistency checks. Reviewers and auditors are repeatedly telling us the same thing. Sections of the report don't tie together. A formal end of process consistency review, MD&A to statements, notes to the face of the financial statements, statistical tables to the financial statements, eliminate many of the most common and frustrating comments. Finally, staff training and terminology updates. Many repeat comments come from outdated templates or cut and paste carryover. Regular training and annual terminology review help ensure the report accurately reflects current GASB standards, not last year's language. So the big takeaway is cleaner reviews don't come from more complex accounting. They come from better process, better sequencing, and better discipline at the end of the year. Fix the process, and most of these comments go away without really changing any numbers.